Good day, and welcome to the Absolute Growth Portfolio Update for the second quarter of 2025. I am Vivian Pete, and I'll be walking you through this quarter's key market developments, our investment approach, and how this portfolio continues to deliver steady, inflation-beating performance even in uncertain times. We'll first take a quick look at the macroeconomic and market developments, both globally as well as locally. Then we will revisit the investment philosophy and how it continues to guide decisions in volatile market conditions. We'll follow this with a deep dive into performance bonuses that have been declared, risk-adjusted returns, and how we're tracking against competitors. And finally, I'll wrap up with a few key takeaways and leave you feeling informed and confident about the way forward. The most prevailing themes in the global as well as local economic environment include the following. The global economy is resilient, but still faces tariff headwinds. The South African Reserve Bank cut interest rates along with other non-US central banks. South Africa's political uncertainty rises, but economic reform continues. We will unpack this in my next few slides. PMIs, which are short for Purchasing Manager Indices, are early indicators of economic health. They show whether businesses are growing or shrinking within an economy. A PMI reading of above 50 signals expansion within that economy, while a reading below 50 suggests contraction within that economy. As at the end of June of 2025, the latest PMI data is pointing to resilience in key global markets, even during policy uncertainty and geopolitical risks. Policy support in China and in Eurozone area will likely limit the fallout from US policy and growth uncertainty. A significant weaker US economy is expected over the next 6 to 12 months, with a recession still likely. For looking from a South African perspective, South Africa's wide PMI data also just stayed above the neutral 50 mark as at the end of June of 2025, marking a third straight month of expansion and suggesting a pickup in activity after a weak Q1 GDP growth. Challenges persist, such as renewed uncertainty about US import tariffs, which pose a downside risk to growth forecasts. However, elevated gold prices and lower international oil prices could mitigate some of these impacts, and a considerable share of South Africa's export commodities have been exempt from these tariffs. Inflation expectations eased across all social groups and time horizon in the second quarter of 2025. We saw headline inflation coming in at 2.8% in the month of April as well as in May. It was up to 3% in June of 2025, and this slight increase has been caused due to higher food prices, housing, and utilities. South African inflation has been near or below the target floor for 8 consecutive months, which created room for a 0.25 interest rate cut in May of 2025. The inflation outlook is expected to hover around the 4% mark for the next 2 years. This is significant because it creates a space for further interest rate relief and a more supportive investment environment in the future. It also bodes well for real returns, and the key there is beating inflation over time. Markets responded positively in the second quarter of 2025. We saw global equities rebounded as trade tensions eased slightly. From a local perspective, we saw strong performance across South African equities, listed property, as well as South African bonds. We saw a weaker dollar helped the rand hold firm, adding further support to South African assets. Our diversified exposure within our absolute growth portfolios meant we benefited meaningfully from these movements. This chart represents a comprehensive view of how various asset classes have performed over multiple time horizons, ranging from 3 months and all the way to the past 10 years. It reinforces one key message. Staying invested in a well-diversified portfolio pays over time. If we start looking at the shorter term period, and that's the 3 months to the 1 year period, we've seen a strong recovery in South African equities that's just under the 10% mark. We saw strong return from South African listed property above the 10% and South African bonds at around 5.9%. And these recoveries have been supported by our lower inflation environment, a weaker dollar, and a rally in resources, particularly higher gold and platinum prices. Global equities also performed well over the last quarter at 7.8%, rebounding sharply from the first quarter market correction we saw. Over the 1 year, we see the recovery continuing Within South African equities, landing at 24% over the past year, South African listed property leading the pack at above 25%, and South African bonds. Now let's zoom into the medium to longer term periods, looking at the 3 years, as well as the 5 years, 7, and all the way to the past 10 years. What we see over the medium and the longer term is a clear divergence in performance amongst these asset classes. We see global equities have delivered exceptional performance, consistently exceeding CPI plus 7% mark. Local equities, while they're recovering, have been below the CPI plus 5% line for over the 7 as well as the 10-year period. This indicates a challenging environment for local investors over the longer term. This, once again, reinforces the value of our global diversification approach within our smooth bonus portfolio. It's not enough to rely only on one market. We blend local recovery potentials with global growth drivers to protect and grow your assets across market cycle. The message to our investors is clear. Even through market cycles and global uncertainty, these asset classes recover. And when combined with our smoothing mechanism, they provide a powerful formula for long-term value creation. We will look at how this feeds into our investment philosophy and investment performance. Our investment philosophy remains rooted in a dual focus. The first one is growing your capital, the second one is protecting it. That is why we invest across multiple asset classes locally as well as offshore. And why we actively manage this mix of asset classes through tactical asset allocation. It's about building long-term wealth without taking unnecessary short-term risks. That is why our approach is built around risk-adjusted outcomes. How do we ensure the risk is managed? We do this in 3 ways. Firstly, we diversify the investments across various asset classes, balancing traditional equities with unlisted markets in alternatives and interest-bearing instruments and real assets. This helps reduce the reliance on any one market event. We reduce the volatility, secondly, through formula-based smoothing and the use of a bonus smoothing reserve. We protect further by limiting the downside risk through the use of guarantees. The absolute growth portfolio is a diversified portfolio that is invested in the market to generate investment return. It is also designed to provide growth across various market conditions. To achieve the gross CPI plus 4 to 5 to 7% target over the long term, the absolute growth portfolio has a diversified strategic asset allocation globally as well as locally, comprising of equities, fixed incomes, alternatives, and real assets, with a consolidated exposure of 83% to growth assets. You have to be aggressively invested and take the risk that comes with chasing the returns. But within this portfolio, that risk is not passed on to the member. With a robust risk management framework in place, we're confident that the absolute growth portfolio is well positioned to deliver long-term real returns while minimizing risk. Let us test this when we look at the investment performance. Looking at the investment performance perspective, we'll start to look at the monthly bonuses that have been declared. Month after month, we've declared consistent monthly bonuses, reflecting our ability to smooth returns while participating on the upside. We saw in the month of June of 2025, the absolute growth smooth as well as the absolute growth stable portfolio, both declaring bonuses of 0.97 as well as 0.93%. That brings the annualized growth bonuses declared to 12% for the absolute growth smooth, as well as 11.59 for the absolute growth stable, both above inflation. That is the real value that's been delivered. As local equities rebounded over the past year, our absolute growth portfolios were well positioned to participate in the upswing. This wasn't by chance. It's a result of active portfolio management and disciplined exposure to growth assets such as the South African equities. The outcomes speak for themselves. Strong, consistent returns that comfortably outpace inflation. Over the past 3 years, 5 years, and even 10 years, both the absolute growth smooth and stable portfolios have delivered real returns measured after inflation. That aligns with their long-term CPI plus benchmarks, and that is highlighted in the gray areas on the graphs. This consistency across time horizons highlights the strength of the strategy. It's not about capturing growth alone, but doing so in a way that is repeatable and reliable. The bonus smoothing reserve is a key feature within the absolute growth portfolios. It functions as a shock absorber, When markets are volatile, we draw from this reserve to maintain stability in declared bonuses. This has helped protect members during periods of market downturn while still allowing for inflation-beating returns. Take comfort today. At this 5 to 10% bonus smoothing reserve level, as at the end of June of 2025, investors can expect continued inflation-beating returns over the next 24 months period, despite all the uncertainty in the market. When we compare the absolute growth smooth as well as the absolute growth stable portfolios to traditional balance and absolute return funds in the market, the results are striking. Over the past 10 years, the absolute growth smooth as well as the absolute growth stable have delivered returns comparable to those of traditional market-linked funds, but with significant lower volatility, smaller levels of drawdown, and only one negative month over the 10-year period. Here we can see the dual objective of the absolute growth portfolio have been met. This is to grow your capital competitively with minimal levels of volatility. That is what smart risk-adjusting investing looks like. In closing, despite ongoing global trade tensions and high tariffs that create policy uncertainty and adverse effects on international trade, our smooth bonus portfolios have stayed the course. These challenges haven't derailed us. Instead, they've highlighted the strength of our approach. Our diversified underlying portfolio has enabled us to capture opportunities and consistently declare inflation-beating bonuses. And our bonus smoothing reserve remains a powerful buffer, acting as a shock absorber in times of volatility and uncertainty. It is this balance between growth and protection that sets the absolute growth portfolios apart. You get strong real returns, lower volatility, and the peace of mind to stay invested for the long term. Thank you for your continued trust. We'll keep doing the work behind the scenes, and we look forward to updating you in the next Smooth Bonus quarterly update. Thank you and take care.